Welcome to The Explainer. Let's just dive right in today because we're tackling a topic that has absolutely captivated the entire financial world. I'm talking about Nvidia's completely mind-boggling valuation. Look, we all know they're a mammoth company, right? But analysts are now whispering numbers that just seem, frankly, impassable to comprehend. So we're going to break down a super detailed 40-quarter financial analysis to find out exactly where these massive projections are actually coming from. And that brings us to the massive elephant in the room. $10 trillion. Or hey, maybe even 12 trillion. That is roughly double where the company has been trading recently. And to put that into perspective, it's literally more than the GDP of most countries. When we see a number like 10 trillion, our immediate gut instinct is just to reject it, isn't it? It feels completely absurd. It kind of feels like the market has just lost its collective mind. Which leads us to, honestly, the most important question we can ask today. Is this all just runaway AI hype, or is there an actual historical, mathematical foundation for these astronomical numbers? Today, we're going to step away from all the emotional headlines and the wild speculation. Instead, let's treat this like a data-driven detective story. We're going to view this through a strict if-then framework, based purely on NVIDIA's own financial reality.
Okay, so part 1, 40 quarters of history and setting a 10-year anchor.
You see, to figure out the future, we really have to establish our anchor in the past. We need to look at a full decade of solid data to see how the market actually values this company through different business cycles. But before we jump into the numbers, we gotta talk about how we're viewing them. Over the last decade, NVIDIA's earnings have skyrocketed from hundreds of millions to tens of billions. If you just toss that onto a standard linear scale, those early years just look like a flat line, and the recent years look like a vertical rocket ship going straight up. It completely hides the actual trend. So we absolutely must use a logarithmic scale. This compresses those massive scale shifts so we can clearly see the proportional relationship between their earnings and their market cap. When you plot this out on a log-log scatter graph, where every single data point represents one of NVIDIA's last 40 quarters, things get really interesting. Think of the horizontal axis as the actual GAAP net income, so the pure corporate earnings power for that specific quarter. And the vertical axis is the market cap that investors assign to the company at the end of that exact same quarter. This isn't just a generic trend of a stock price going up. It's asking a very specific question. Historically, when NVIDIA made X amount of profit, what did the market say the whole company was worth? And when you see a tight little cluster forming along a clear trend line, yeah, that is a very, very strong pattern. To really grasp just how strong that pattern is, we have to look at the R² value of that trend line. It is 0.900. Now, in the statistics world, an R² of 0.900 is remarkably high. In plain English, it basically means that roughly 90% of the historical variation in NVIDIA's market cap on this logarithmic scale is statistically associated with changes in its quarterly earnings. It tells us that, yeah, sure, hype and sentiment definitely exist, but earnings have historically been the massive, heavy anchor driving NVIDIA's valuation over the long haul. So from that historical data, the analysis extracts a core equation. Market cap equals 186.8 times net income to the power of 0.914. Okay, don't worry about the complex math there. Here is the big takeaway you need from this. Historically, every single time NVIDIA's earnings doubled, its market cap didn't quite double along with it. It increased by about 88%. And, this actually makes perfect economic sense. As a company gets more and more massive, the market naturally, gradually trims the valuation multiple, simply because sustaining that kind of hypergrowth gets a lot harder. But the equation proves that as earnings climb, the market cap follows right behind in a mathematically predictable way. Moving on to section 2, projecting the future, based on Wall Street's estimates. Okay, so we've got this historical equation that clearly works. What happens if we take Wall Street's forward-looking earnings estimates and plug them directly into it? Let's walk through these two scenarios. Analysts estimate that in about 12 months, NVIDIA could be generating around $77.9 billion in net income per quarter. Plug that into our trusty equation, and the historically implied market cap is roughly $10 trillion. That's about $410 a share. Now, look at the 24-month horizon. An astounding $93.8 billion in quarterly profit. Run the math there, and the equation spits out an $11.9 trillion market cap. So you see, the model isn't just randomly guessing these wild heights. It's a mechanical output driven entirely by Wall Street's own massive expectations. All right, section 3, the valuation sanity check. Let's look under the hood. Look, I know those market cap numbers probably still sound like total science fiction, so let's do a quick sanity check. The source material gives us this fantastic quote, and it goes, "The decisive issue is future earnings growth, not simply the absolute size of the market capitalization." You see, when we stare at a giant number like 10 trillion, we get totally blinded by the sheer scale of it. But a company's worth is ultimately about the cold, hard cash it generates. We simply cannot look at the price tag without looking at the underlying engine driving it.
And right here is the hidden aha moment of this entire explainer. If Nvidia actually hits those 12-month estimates, which comes out to roughly $311 billion in annualized earnings, and it's trading at a $10 trillion market cap, guys, that is only a 32 times earnings multiple. Just let that sink in for a second. To be worth $10 trillion, Nvidia does not need to trade at some crazy 100 times multiple like a ghost from the dot-com bubble. A 32x PE ratio is highly reasonable. It's even standard for a dominant, rapidly growing tech company. The valuation itself isn't actually what's extreme here.
Which brings us to Section 4, risks and caveats, or where this all falls apart. Before we get completely carried away with all these trillions, let's bring ourselves firmly back to reality. This entire mathematical framework rests on some absolutely monumental assumptions. Let's rapid fire through the potential pitfalls here. First off, what if the earnings estimates are just way too optimistic? A tiny percentage miss on $300 billion means tens of billions get wiped out. Second, what if hyperscaler AI capital expenditures start slowing down? Third is competition. AMD, custom silicon from giants like Google and Amazon, they are all coming for this pie. And finally, gross margins. Even if revenue keeps growing, if their margins shrink, the net income drops. Remember, Nvidia has never generated $90 billion in a single quarter, so we are predicting way outside the bounds of our historical data. We also definitely have to consider valuation compression. Let's say Nvidia actually hits that massive 24-month target of $375 billion in annual earnings. But because the company is now fully mature and the hypergrowth is slowing down, investor sentiment shifts, so they only awarded a 25 times multiple instead of a 32 times multiple. Well, suddenly your market cap is 9.4 trillion, not 11.9 trillion. It just goes to show how a really simple shift in how investors feel about the future can drastically alter the final valuation, even if the company executes absolutely perfectly on its earnings. Now, there is also one big upside wildcard to consider, and that's share buybacks. Currently, sitting at roughly 24.2 billion shares, every $1 trillion increase in market cap adds about $41 to the share price. But Nvidia has massive stock repurchase authorizations. If they aggressively buy back shares, retiring them from the market, well, the pie is split into fewer slices. That means the per-share value could climb significantly higher than our $490 estimate, even if the total market cap just stalls out at 10 or 11 trillion. So we arrive at our final and definitely most crucial takeaway. The mathematical relationship between Nvidia's earnings and its valuation is historically ironclad. A $10 trillion valuation at a 32x multiple, it is logically sound. Therefore, the question really isn't, can the market support a $10 trillion Nvidia? The real lingering question you should be asking yourself is this: can Nvidia actually deliver $94 billion in clear, pure profit in a single quarter? Because the valuation isn't the crazy part. The required earnings are. Keep your eyes on that quarterly net income, because at the end of the day, that is the only metric that truly matters.